Jeremy, resume your seat. Ladies and gentlemen, I'd like to introduce Lorraine Meldrum, the newly crowned Managing Director of Swan Global, one of our principal sponsors, to the stage to introduce our speaker. Lorraine.
The gold price has fallen by around 30% in the past 2 years, yet Northern Star's share price has nearly doubled in the past year. And to add to that, the shares were the best performing stock in the ASX 200 in the last financial year. Bill Beament has been the Managing Director of Northern Star since 2007. Bill is a mining engineer. He grew up and studied for his degree in Western Australia. He then had 15 years in mine management in both mining companies and contracting companies providing mining services. In fact, he ran his own underground mining services company. After that time, he moved to join NSR. After several lean years, Bill secured a $40 million deal for the Paulsens gold mine in WA. It repaid the acquisition price in 7 months, and he's been acquiring gold mines ever since. There are some other points. Northern Star's mine assets have increased very substantially since he became Managing Director. There's been production growth, exploration success, and strong operating results. And to add some more numbers, normalised underlying free cash flow for the September 2014 quarter was $50 million. That's more than the comparable figure for the whole of Northern Star's 2014 financial year. Yes, Bill and his fellow directors do understand and look to meet the criteria used by investment institutions for judging mining companies. Now, considering that we're approaching the festive season, I've asked Bill to give something to us all, some pearls of wisdom and insights into his way of achieving the right outcomes. So, ladies and gentlemen, please welcome Bill Beament.
Thanks very much, Lorraine, for the introduction. I feel like she's already did my talk. And thanks to the Melbourne Mining Club for the invitation to speak today. I know that offers to address this prestigious gathering are hard to come by as high-grade ore bodies in Western Australia. So now I count myself extremely lucky to have several of those, and now one Melbourne Mining Club invitation. Having said that, I'm very mindful of the fact that there are a number of people in this room with a lot more mining experience than me, and therefore I'm desperately keen to avoid any commentary or observation that could be interpreted as a patronising lecture, especially when you're sitting across the table from guys like Hugh Morgan. Speaking in the home of Australian rules, I'm very aware that our industry is somewhat known for having more than its fair share of lumbering full forwards who kick a bag full of goals in their first few games and then play out the rest of their careers in the reserves. And just to continue that analogy briefly, I think it's fair to say that Northern Star, we've put in a solid but not a spectacular first quarter. Then we've maintained possession, we've taken a couple of high grabs, and more recently we're starting to convert these into goals. But we are a long way from a grand final. We know it takes 4 quarters to win a game of footy, and that the VIX will always be against us. But unfortunately, it's the shareholders, not the VIX, that we really need to please. So please don't think for a moment that I'm here to launch any memoirs about my time as being a full forward. Instead, I'd like to throw the conversation forward somewhat to examine a couple of issues which I believe will be of increasing importance to those of us who, God and shareholders willing, will be around this wonderful industry for some time to come. Now, I've just returned from a short break in the US where I celebrated my 40th birthday. I don't think my wife believed I'd make it. I also took the opportunity to clean my head out a bit. I read some of the local financial press over there and generally have a bit of a think of where the Australian gold mining industry is at. I couldn't help but keep coming back to the conclusion that our industry is entering a new chapter. In fact, it's even more dramatic than that. It's more like a new era, except it's not new, but more of a case of history repeating itself. 25 years ago, underground mines dominated the Australian gold industry, and the focus was on mines with grades north of 5 grams and low costs. Then carbon and pulp and heap leaching processing technologies burst onto the scenes. In the 1980s and 90s, this technology became to the industry what the pan was to the first prospectors. It turned 1 to 2 gram waste into ore overnight. In the process, it revolutionised the whole focus of the industry from production, exploration, through to the investment analysis. In the decade from 1981 to 1990, Australian annual gold production grew from 18 tonnes to 244 tonnes a year. Over this modern day gold boom, the ability to make money from processing 50 to 30 tonnes of dirt to produce 1 ounce of gold meant that low-grade ore bodies now became economic. It also reshaped the exploration industry. Suddenly, the pursuit of shallow, low-grade deposits was well worthwhile. This style of exploration was cheap, easy and fruitful. It spurred an industry in itself. As many in this room will remember, there was a rash of small to mid-cap Western Australian gold mining companies listed on the ASX in the mid-90s. In the process, deeper exploration well and truly fell by the wayside. Underground gold mines become unfashionable as share prices surged on the back of shallow, low-grade ore bodies. There's no doubt that this era was kind to shareholders. It certainly was kind to a few brokers and people that finance projects in this room. But the reality is that in 10 years' time, the open pit party is going to be all but over. Sorry, playing with trouble with that. This graph up on the screen at the moment, this is from the Geoscience of Australia, and this highlights the current number and scale of major Australian gold projects, predominantly in production. But at the current gold price, and based on known reserves, there will be only 3 operating gold mines in Australia in 10 years' time. You've got Cadia in East, which is a big underground. You've got Olympic Dam, which is a byproduct, 70,000 ounces a year from the uranium mine. And of course, Boddington under Newmont. And when you look at WA is a home to more open pit mines at the moment than any other state. But as I said, in 10 years' time, the only one being around will be Newmont's Boddington operation. By the same token, at the moment, WA has about 30 active underground mines. As it happens, 5 of these are owned by Northern Star. Now, the reversal of this 25-year trend is now well and truly underway. And not because there's a particular problem with open pits, but because the low-hanging fruit, or in this case, the shallow lying fruit, has well and truly been picked. And as the data for Centre of Exploration Targeting shows, 80% of Australia's continent is under-transported cover, and effectively it's blind to previous exploration technologies. Also in Australia, 56% of all gold mined each year now comes from underground versus 44% from open pit. So the tide is rapidly turning. I believe that there's a lot more gold to be discovered in Australia, but it's going to be found at depth and below cover, which will require underground mining techniques. In my experience, underground mining techniques lend themselves well to selectivity. We're able to mine discrete ore zones, very different to open pits. Flexibility. We can rapidly change our mine plan in response to wild commodity prices, as of what we saw last night, a jump of $50 or $60 an ounce. Whereas if you're stuck in a pre-strip for an open pit, you're stuck in a pre-strip for an open pit. And also, we operate a much smaller environmental footprint, and hence we have much lower rehabilitation and closure costs. So a good example of this is Northern Star's latest mine, which is our Pegasus deposit. Now this is a discovery which will be in production early next year, and this ore body highlights the lower sensitivities associated with an underground mine and their resilience to a weaker gold price. This is why an underground mine will remain in production longer than a typical low-grade open pit. I won't put the pointer here, but it's interesting to note if you take a typical cut-off grade for underground around 3 grams, we've got about 700,000 ounces there. If all hell broke loose with the gold price and we had to raise cut-off grades to 5 grams, we only lose about 16% of our ounces in our resource model. But our head grade goes from basically 8 grams to about 12 grams. So we can weather the storm a lot better. But when you start looking at open pit, it's a very, very different story. At a 0.5 gram cut-off, you've got nearly 270,000 ounces. If you just raise that half a gram to a 1 gram cut-off, then you drop 45% of your ounces, yet your head grade only goes from 1 gram to 1.4. And most importantly, I believe that successful miners will have to be more selective in the ore they mine and be more productive. These are the real drivers of the return on shareholders' funds, which of course is the ultimate benchmark for any business. Now, there are a host of issues which will flow from this transition of open pit to underground as the industry transitions. But one of the most challenging for explorers, producers and investors alike will relate to the contentious issue of demonstrating mine life. The open pit era regularly delivered mine lives of 7 to 10 years. The low cost of drilling out the shallow ore bodies from surface gave rise to the widely held view that a project with fewer than about 7 years of proven reserves was barely bankable, let alone an attractive investment opportunity. This had another major implication. It helped foster an inventory-driven approach to investment and analysis of ASX-listed gold stocks. In Australia, the investment community places a heavy emphasis on a company's reserves and resources. Valuations are based in large part on these measures, and overall market sentiment is driven to a large degree by mine life, something which we've suffered of late. But in the world of underground mining, in most cases, it is simply not feasible to conduct the drilling programs needed to establish mineral inventories of this magnitude. The cost of undertaking such extensive, deep drilling from surface is simply prohibitive. Therefore, the ability to establish mine lives of 7 to 10 years is, in most cases, not just an unrealistic expectation, but it's against the best interest of your shareholders. So this creates a bit of a conflict between what the investment community supposedly demands, and what is truly in shareholders' best interests. The reality is that the investment community in Australia needs to reset its gauge. Proven mine lives around 3 to 5 years will be the new norm. Most underground miners simply can't justify the cost of establishing a proven inventory beyond this, and the market is moving back to where it should be. I believe that some of the emphasis placed on reserves by the investment community should be replaced with an increased focus on resources and, more importantly, operating free cash flow, operating margins, and financial metrics such as return on equity and return on invested capital, which more appropriately measure total shareholder returns. And some of Australia's most successful and longest-running underground mines have rarely, if ever, had mine lives more than 3 years. Yet through ongoing drilling, they've maintained a steady life while minimising costs to shareholders. So at Northern Star, the first mine we acquired was Paulson's, which only had a 6-month mine plan and a 130,000 ounce resource. That was in 2010, and production commenced there in 2005. We've consistently produced about 80 to 100,000 ounces a year at Paulson's ever since. It currently has a resource base of north of 400,000 ounces. It's got a fantastic conversion rate of nearly 100% from resource to reserve and what actually you pull out of the mill. On this basis, Paulson's has at least a mine life of 4 years. And this is before taking into account additional mineralisation we have intersected but not drilled to JORC resource standards, and before allowing for further extensions of known mineralisation. It's not a very deep mine. And Plutonic. Sorry, the pointer's a bit slow. And Plutonic, which we purchased from Barrick this year, it's celebrating its 25th anniversary. Started as an open pit for the first 7 to 10 years, and then in 1995, on a modest 40,000 ounce resource, not reserve, resource, it transitioned to an underground operation and has now produced over 3.2 million ounces since. And Plutonic still has a great resource. It's still got about 1.45 million ounces of gold in resources. In addition to these resources, we've outlined further mineralisation. Again, these assets are big, multi-lateral systems. Plutonic systems, 3.7 kilometres. It's not a very deep mine. Our centre of activity is around 400 or 500 metres. There's mineralisation everywhere. You just got to drill it, but get platforms underground to drill it. At Jundee, reserves stand at approximately 400,000 ounces. This would suggest the project has a mine life of just 2 years. But we have resources over 850,000 ounces, and we believe these will grow substantially. Jundee is a fantastic ore body. This diagram you're looking at, if you look at the stoping in orange, the shells that have been mined out, the other shells are the red shells, which is all the mineralisation remaining in this system. Again, a big lateral extent, 5+ kilometre system, over 6 million ounces has come out of this ore body to date. Again, our centre of activity is only 400 or 500 metres. But it shows you between resources and reserves and unclassified mineralisation, which is your mineralised envelope, there's substantial life in these assets to come. As these examples show, on a strict definition basis, Northern Star has mine lives of fewer than 4 years across each of its operations. Yet the fact is that our portfolio of mines in the last 20 to 25 years has produced in excess of 21 million ounces, which gives us great confidence to know that all our operating mines will be going well beyond this date. But we're not going to spend excessive shareholder money to establish this just because the rule book says we should. Instead, we have budgeted $50 million for exploration and drilling. Of course, some of this will be used to convert resources to reserves. We need to replace what we mine from this category and perhaps a bit more. Some will be spent trying to discover new mineralisation at, around and close to our existing world-class ore bodies and operations. But a significant part of this budget will be spent further defining and bringing known mineralisation into resource, reserve and, more importantly, mineral inventory. And I'll repeat that, it's very important. Mineral inventory is what we as a management group put our hand on our heart and believe that we will mine in the future. I think that's one of the key categories that we need to talk about. A year ago, the key criticisms of Northern Star were lack of scale, the risks associated with being a one-mine company, and our lack of mine life. We've resolved 2 out of those issues. We are now producing at a rate of 600,000 ounces per annum, all-in sustaining costs of around about 1,000 Australian an ounce, and generating a lot of substantial free cash flow, like Lorraine mentioned. And we have 5 operating mines now. Our next objective is to grow mine lives, though, but we won't necessarily seek to grow it according to the JORC rulebook. In many cases, it's just not feasible. Instead, we'll aim to demonstrate clearly that we have this life in the bag via a combination of well-established mineralisation, resources, reserves, mineral inventory again. But we'll be urging the investment community to take these categories into account more than perhaps they have done in the past when assessing our value and our future. We'll also try to get them to place a greater emphasis on earnings. Last quarter, as Lorraine took my thunder, Northern Star generated underlying company free cash flow of $50 million, which was more than what we did for the whole of last financial year, substantially more. I'd just like to revisit the point about our $50 million exploration budget for a minute, because it tells a bigger story about the change underway in the Australian gold mining industry. For the sake of the argument, if you divide that amount among each of our 5 operations, that's $10 million per mine. It shows that the days of the $5 million gold company float are as good as over. Those companies succeeded because a capital raising of this size was sufficient to conduct a shallow exploration program and establish adequate resources and reserves to underpin an open pit development. This usually involved drilling to about 200 metres at depth. In many cases, the drilling followed up historical results and mining which had been undertaken to a depth of about 100 metres. So to go to 200 metres was a new frontier. The combination of advancements in drilling technology and the new processing techniques I referred to earlier made these relatively small companies very fruitful for shareholders. It was a new chapter in the Australian gold mining. Now we're entering the next chapter. The need for deeper and more sophisticated exploration is making it very difficult for these companies to undertake realistic or meaningful exploration programs. Once the administrative and corporate overheads are deducted from the proceeds of a typical IPO, there's simply not enough left to implement a significant exploration program capable of finding blind deposits hidden beneath significant amounts of cover. And look, while gold producers have been grappling in recent years with their own challenges in terms of making their businesses more appealing to investors through increased transparency of reporting and a focus on profitability rather than volumes, the junior gold exploration sector today is grappling with perhaps the biggest challenge of all: whether it will survive. At the same time as the $5 million float of shallow explorers comes to an end, the global gold miners are offloading many of their mines, such as those that we have acquired, because they see them as being too small to meet their criteria overall. This is despite their strong, ongoing production and financial results we're achieving and their significant exploration upside. These circumstances have made this new chapter the era of the global mid-cap gold producer. Mid-caps are now the Goldilocks producers. Not too big, not too small, but just right. Mid-cap producers have the scale needed to keep costs down. Scale is now a key requirement of global investment institutions. Mid-cap producers also have the cash flow needed to undertake this deeper exploration and development. Mid-cap producers' management teams are naturally closer to the coalface and therefore have a better handle on the risk-reward scenarios. And they have a portfolio of operations rather than relying on just one mine. Again, this asset diversity is now a must with global investors. Of course, this all combines to allow mid-cap producers to something else beyond the reach of small miners. They can pay the shareholders their much-loved dividends. And look, finally, before I take any questions, I'd like to give you a firm example of what I've been talking about in respect to deeper exploration and the amount of gold which remains to be found in states like Western Australia. About half an hour ago, Northern Star announced to the ASX that we made a significant discovery at the White Feather project near Kalgoorlie. Our first round of drilling has returned spectacular results, such as 1 metre at 5,300 grams per tonne gold from a vertical depth of 200 metres. Now, White Feather was mined over 100 years ago. It is located 2 kilometres from Kanowna Belle mine, and it was the reason the Kanowna Belle township was built back in the late 1800s. It's only 15 kilometres from the famous Kalgoorlie super pit and was part of the package we recently acquired from Barrick. These initial results highlight the gold riches that remain to be found and mined in Western Australia. But the old ways are not going to going to bring them to life. The future of Australian gold mining industry is about bigger companies, deeper drilling and underground mining. In the process, we will all need to change our ideas about aspects such as mineral inventories, mine lives and shareholder returns. I believe the Australian gold mining industry has an outstanding future, provided we are all prepared to keep questioning the way we go about our business. Thank you very much for listening to me. I'm happy to take any questions.
Giving him something to think about. Thanks very much, Bill. If you have a question, we've got 2 microphones roaming around attached to both Gavin Collery and Richard Shoddy. So if you would like to ask Bill a question, and if you haven't got a question after that, then it's probably not worth asking. Gavin's down here. Please stand and tell us who you are and then ask your question. Thanks.
His name's Hugh Matheson Morgan. Oh, it's not. It's Louis.
Bill, Elizabeth Lewis-Gray from Ostmine. Thank you for a great presentation. At the beginning of your presentation, you talked about a great technological change that actually reduced the cut-off grades and really developed the industry in Western Australia. And of course, being from the mining supply sector, we're always looking for the next opportunity to make that difference to the mining industry. Do you see any signs of technologies or services, particularly obviously in the underground drilling or underground discovery area, that you think can make a substantial difference to the cut-off grades in gold mining?
Yep, thanks. Well, I
Sorry.
can't get Wi-Fi underground from my Gen Y yet, but I'm sure they'd love it to get onto Facebook underground. But no, look, we're still doing the same stuff in underground mining. We're still boring, firing, bogging like we were doing back in Western mining days 20, 30 years ago. So that hasn't changed a lot. The quality of the equipment's improved a bit, and there's efficiencies that have come with that. But I think exploration is a real frontier of science that's happening, and I'm talking geophysics. That to me is the future of the Australian sector. Iron ore, you go to the Pilbara, you'll find it every stone you kick over. But if you want to find the next copper, next gold, next nickel discovery, have a look at the major discoveries in Western Australia. Sirius, Samphire, Tropicana, all found undercover from geophysics initially. And then some people got lucky with a drill bit after that. But I think that geophysics is extraordinarily important. We're starting to use 2D seismic, more importantly 3D seismic. I know my company is one of the first to use 2D seismic in the gold. Some others are now using that in 3Ds, and we've got a 3D survey on now. So I think that's a big future for finding the stuff. One thing I think that people aren't reporting about too much in the gold sector is I hate this analogy where people say ore bodies get lower grade as they get depth. That's wrong. It's come from up there. It's come from underground. But to me, what's important, and the sector being important, is you can raise your cut-off grades, and that's what's happening across the globe now. Very difficult to do in an open pit, but in underground we can raise our cut-off grade tomorrow and selectively mine. So you're seeing all the majors doing that now. They're upping their cut-off grades, doing their resources and reserves at a different gold price, and that will give a better margin per ounce, but won't give the same production profile.
Hi, Shane McNeese. As mines get deeper, you need more and more energy to get down there. How favourable do you think the current crisis in the oil industry and energy industry is?
Look, obviously oil has fallen quite substantially, but I don't know if you go to the pump and get diesel, it hasn't really fallen too much in diesel terms. In unleaded it has. But so look, that hasn't really flowed through to a degree. But underground's quite interesting. Underground probably, when you look at energy is probably 10% of your overall cost base. And I'm talking diesel and energy, whereas in an open pit it's about 30%. So as you get deeper, yes, you have to put more energy into your mines, but it's not a huge cost impost in your operation compared to open pits.
Thank you for a very interesting speech. I'm Associate Professor Claire Wright from La Trobe University. I'm really interested in the fact that you're talking about deeper mining, because one of the things that happened in 1854 in Ballarat was the transition was made from shallow alluvial to deep vein, deep lead mining. And so and some of the tensions that arose over that year that as we've seen erupt in the Eureka Stockade, came from managing that transition. So I'm wondering whether you have a sense of what the social or political implications of the future that you imagine might be.
Yeah, look, that is an issue that's going to hit not just gold, it's already hitting nickel at the moment. If you go through Western Mining, some of the marquee mines like Ottajuana shut now that were just the mainstays, but depth killed them. The mineralisation continues. Even one of our mines is potentially shutting in two years' time because of depth constraints. But it's an issue that's going to hit the industry really hard in the next 15 or 20 years. If you go to South Africa and have a look at the depth that they're mining at, you can mine at depth, but we've got to train the whole industry professionals to throw out their geotechnical, what they'd learnt in uni. We designed everything in Australia to stand up, whereas in South Africa they designed everything to fail. So you've got to throw everything you learned in your whole career out the window. But it's something we do need to develop in universities moving forward because it is going to hit us in the face and it's not that far off as an industry. Yep.
Richard Shoddy, I actually have a question for you. I agree completely with your comments about the shift towards deeper mines and going underground. Also the issue there of the flexibility of the gold price and how that impacts on the cut-off grades. A lot of companies report their resources and reserves on a fixed cut-off grade. What you're suggesting here is actually that they should actually put a range of numbers in on their reports. Do you agree with that? Is this something that we should be going forward with?
Yeah, look, I think you're seeing that. I have to look in the JORC 2012, but definitely in 43101s on the North American reporting they've got grade tonnage curves in their resource statements. They're very thorough. I'm not quite sure about JORC 2012 whether it's in there. I've seen a few reports where it is, but I don't know if it's statutory or anything like that. But I think it's good practice, to be honest, to put in those ranges of grade tonnages.
We'll see that in the Northern Star annual report next. I have another question here from...
Hi, it's Sandra Close from Surbiton Associates. Welcome over here, Bill.
Thank you.
Many things we could talk about, I know, but I'll restrain myself and just ask you if you'd comment on exchange rate, reminding people that in 2009 we were down at 63 cents. We went up 18 months or so ago to $1.10. We're now down on the slide at 84, 85 cents. And for the mining companies, particularly gold mining companies, that's been an interesting run, as it has been in the past. It saved us very much in around 2000, and it seems to be helping us very much again now. So your comments on that and your view perhaps from Northern Star on hedging, be it options or forwards. Thank you.
Yeah, look, obviously I think that's lost on investors at the moment is, we're currently, when I got up on the stage, gold price was $14.30 Australian. That's not a bad price. We do our budgets on $13.50, so that's, an extra $80 an ounce on 600s, that's 40 odd million bucks to the bottom line, so that's a substantial change. So I think that's a bit lost, but the gold sector's always been about the US denominated price, and that drives sentiment across the globe. And most of the investors are global, so there's a bit of a double-edged sword. If they think the currency's dropping, they don't want to invest in you because there's a natural, they're going to lose their money if it's going to drop. If it's going up, it's the other way, obviously. But so that's an issue. We have been immune in the gold sector in Australia with that currency. It's been fantastic for us. But that said, it doesn't really, from a revenue side, it's great, but from a cost side, 99% of Australia's gold sector procures from within Australia. That's our cost base. So there's not a lot of influence really on currency on most of our consumables. Obviously a little bit on fuel, but not a lot overall. Sorry, one last question.
Bill, Richard Morrow from Bailey Holst, coming from the crusty old world of stockbrokers and investors, how do you plan to sort of convince grey-haired old-timers like me that we should change the way we're thinking about, if I can be devil's advocate here, but change the way we think about how we value gold shares?
Yeah, well, as I said, it's rapidly transitioning the sector. There's no open pits around in 10 years' time, so it's up to the industry as a whole to get together and start communicating that and taking people through it. We did it initially with our first mine, Paulson's. It took me probably 2 years to start demonstrating people that ore body and getting people comfortable with that. So it's a whole sector-wide that needs to do that to try and convince that. Otherwise, there isn't a gold sector. Because, like I say, is when you start going underground, There's one underground gold mine in Western Australia with a reserve life greater than 5 years out of the 30 active. Apart from sitting in your office every day convincing you to buy Northern Star script, like yesterday when we bottomed out.
All right, thanks, Bill. I'd just like to invite Patrick Smith from AMC Consultants to the stage for a formal vote of thanks.
Press headlines since 2007 have bemoaned the dearth of Australian mid-cap gold miners. Mid-caps, of which there were many a few years ago, were removed by company consolidation, and the small cap growth up to the mid-tier has been slow. Northern Star Resources has successfully achieved this step up to the mid-tier. Some large mining companies have grown and acquired expensively in recent times. Some of these companies are struggling to deliver on their investment expectations. Northern Star has acquired selectively. They are delivering on expectations, and they're going from strength to strength. I look forward to seeing Northern Star's ongoing success, and I ask you to join me in thanking Bill for his presentation.
You can hand that over to the